Hi, folks, and welcome back. I'm Adam Taggart, co-founder of peakprosperity.com, and I'm back again this week with the lead partners from New Harbor Financial, the financial advisor that's endorsed by peakprosperity.com. We've been talking to the two lead partners there, Mike Preston and John Lodra, for the past couple weeks to help people make sense of what's been happening in the markets, both with the meltdown from the highs and then perhaps this week, a bit of a recovery, maybe a bottom. I don't know. We're going to ask the guys. Mike, John, great to see you guys. Thanks for making it today.
Hi, Adam. Mike here.
Hi, Adam. Thanks for having us. This is John.
Great. And as usual, guys, I know it's just an incredibly busy time for you. I really appreciate you taking the time out of your day for this quick update for our viewers. So today, guys, just want to go through a couple of questions for you to help make sense of the recent action for folks. I guess we should start with the big news, which is that the big bazooka, at least in the US, has been fired. The Fed has dropped interest rates to zero. It's announced more QE, the total size of which we don't quite know yet, but they've said in the amounts needed, which I think is basically sort of our version of the ECB's Mario Draghi's whatever it's going to take, right? And then the Senate just yesterday approved a $2 trillion stimulus bill that's now going on to the House, but it seems to have lots of bipartisan support for it. Something of that magnitude is going to be put forth. And so the markets seem to have at least found a short-term bottom, and we've had a couple of really big up days. I think, can't remember if it was 2 or 3 days ago, but I think the market had its best up day since 1933, something like over 10% on the S&P. So a couple quick questions for you guys. Is this now a market recovery that we're seeing beginning to start here? Is the bottom in? And how does all this announced stimulus change your guys' outlook, if at all, for the markets?
Yeah, I'd be happy to take a first shot at that, Adam. This is John, and Mike, please chime in. It's funny. That was labeled as news, but this was hardly newsworthy. I mean, there was nothing unexpected in terms of central bank coming with monetary cannons here, and Congress coming with fiscal bazookas. This was obviously an expected event, and therefore the market certainly rebounded in an unexpected way. In fact, if you go back to our videos of recent weeks here, we very much expected, irrespective of what went on here, a very sharp market bounce. Markets sold off very abruptly, very very steeply, and much like a kind of rubber band bounces back and snaps back and forth. We expected a very, very sharp market bounce, in part because things got very, very oversold on a short-term basis. We think obviously the part of the stimulus here basically enabled the Federal Reserve to go out and buy all sorts of assets. Not stocks per se, or at least not directly, but corporate bonds for the first time, and so there is a very expected sharp bounce here. We think it's more of an invitation to sell into strength than to take this as the coast is clear. We're in a very precarious situation economically and financially, and this is more of a Band-Aid, we think, than an invitation to sigh of relief that the worst is behind us.
All right, and just to repeat back what you just said there, John, about it being a chance to sell into strength, I'm interpreting that you guys think that really lower prices are ahead in the nearer to medium term here, meaning you don't feel the market has completely found its bottom yet, and this while it may be a relief rally, doesn't mean the coast is clear and that we're going to be returning up permanently to the highs that we were at before. Is that correct?
Yeah, I mean, I'd be happy to chime in a little bit as well. We retraced about a third of the decline in just a few days. We just had a 3-day rally, which has been being hailed as the best 3 days since 1933, on top of the single day that you just talked about the other day. It's pretty typical bounce in a bear market. Pretty fast and furious. The market was very compressed. We used recent weakness over the last couple of weeks to add some very, very small hedged long exposure to our accounts. We're not swinging for the fences by any means. These are very, very small hedge positions, so they're doing well with the bounce. But like John said, we would urge people to use this bounce, as expected as it was, is a perfect opportunity to rebalance portfolios. If you any of these viewers out there might have been caught by surprise by this, it's a really good opportunity to take advantage of the weakness and reduce. I would take advantage of the strength after the weakness and reduce equity exposure.
Okay. And just for folks who might be watching you guys for the first time, maybe they didn't see the previous videos we did with you. Big reason why Peak Prosperity has developed a relationship with you guys and referred a lot of people over to you over the past decade is because of your guys' focus on risk mitigation and risk management. And we talked about this in more detail in previous videos, so I won't go into the details here. But sort of long story short, when we were talking to you guys last week, the market had dropped something over 30%, and you guys had dropped. You'd really been flat to up, and then in the last couple of days of last week, when the precious metal miners had a pretty horrible week, you guys were down a little bit, around 1%, and that was because you had hedged the downside in the miners as well, so it didn't hurt you that much. So, the big discrepancy I want to make sure I highlight for folks in terms of your portfolio management is in this most recent market period, at least up until last week, you guys were pretty much flat to maybe down 1%. The market was down, 30+%. Now that we've had this week's rally, you mentioned that you guys had taken some small, long bets and whatnot. I'm just curious, how is your portfolio faring since we talked last week?
Yeah, we're probably up, we're probably up at 1% or so, maybe 1.5%. We've had probably a 2.5% swing to the upside in our typical client portfolios.
Okay, great. So again, if we're measuring back to the February highs, you guys are at least flat, maybe up a little bit based on that, where the market's recovered a bit, but only a third of what it's lost. So market's down maybe around sort of still in the 20% range.
That's right, Adam. And just to clarify, I think you had asked this question, and maybe I didn't fully answer earlier, that we don't think the bottom is in. We think this was an expected bounce after a compressed market, that has rebounded about a third of its losses so far. Completely to be expected. We think this is a change in character in the market. We think we've entered a bear market. We ultimately expect the market to lose more than half, maybe as much as 2/3 of its value from its February highs. It won't happen overnight. It'll take a while. There'll be lots of ups and downs along the way. That's the way we're seeing it. And we're positioned to take advantage of that, essentially on panic declines. We're taking small hedge positions long, and then we're adjusting on subsequent bounces.
Great. And a reminder for folks, the markets don't travel anywhere in a straight line. And when you have a huge drawdown like we had in the past couple of weeks, seeing a rally like this is not out of the realm of the ordinary, and certainly something that John and Mike had been expecting. Mike, as you said, if you are the mindset that, hey, we are now in a different world, we've switched from bull market to bear market, I think your guys' risk mitigated approach is wise in the sense of not getting sucked into, jumping on the long bandwagon right now and preparing to be prepared that if the market does roll over from here, that's not going to be a surprise to you guys, and you'll have strategies to take advantage of that if and as it does happen. All right, I want to switch gears here briefly and talk about actually something else we spent some time talking about last week. It's just had a lot of new news since we did, which is the precious metals market. So the precious metals had gotten beaten down a bit by the end of last week. It had been a horrible week for the miners. And then they really came roaring back quite well. So prices of gold and silver recovered a bit, particularly silver, which had been sort of smashed down below $12 for a brief period. And the miners began picking themselves up as well. Concurrent with that has been news in the industry of physical supply really drying up. If you are if you're a retail or institutional buyer who wants to get your hands on physical precious metals, it's getting increasingly hard to do so, and it's getting increasingly expensive to do so, especially if you're just a regular person, looking to buy gold coins, silver coins, et cetera. The premiums that you're having to pay, particularly in silver, are getting pretty egregious right now. And at Peak Prosperity, we have relationships with a number of people all throughout the supply chain system, whether they're people that deal, selling bullion directly to individuals, whether it's people that are selling bullion to institutions, whether it's people that are buying from mints and refineries. and they're all reporting that supply has dried up in a way that they've rarely seen before. And talking to a few of the longtime experts that we know in this industry, they have been saying that it really does begin to feel different this time. This feels different than different physical shortages in the past. And what they mean by that is we may be entering the period that we at Peak Prosperity and many others have long been predicting, which is at some point there's going to be a move to physical precious metal, and there's just not that much of it. You know, really, you take about 1% of world demand and move it into precious metals, and you've basically hoovered up every ounce that's there in the market. So, not saying we are definitively there yet, but we are seeing signs that we might be. And given all that, I just wanted to ask your guys' opinions in terms of what you're seeing, given the developments I just mentioned, you know, how you're helping advise people that are saying, I'd like to increase my exposure to precious metals. I guess, what are you guys doing differently, if at all, given that news?
Well, Adam, there's a lot to that question, actually. Many different pieces. I'll give a few comments. I'm sure John will have a few things to add too. You know, first of all, we in our portfolio, we have a core position in mining shares, gold and silver mining companies, which are really historically undervalued relative to the price of metal. And they took a really, really bad hit over the last 2 weeks. They've recovered a lot of it. But, you know, from our perspective, what we saw is just a wholesale selling of metals and miners, you know, and it's almost as if a few hedge funds were in trouble. That's speculation. We don't know that for sure. We saw some really crazy things happen with some of the gold mining exchange traded funds. They were trading at major discounts to net asset value, you know, which screamed of just panic liquidation. And the metals themselves, you know, silver went from like 17 or something down to just under 12. GDX, one of the big ETFs, went from about 29 to 16 in a week. Yeah, I might say that we had hedging on in our portfolio, so most of that drop in GDX was defrayed by the hedges that we had in place and allowed us to hold, you know, through that for the recovery that we see now. So, you know, we think that there was some panic, you know, some wholesale liquidation, because everything that we see here with central bank money printing and the panic that central bankers are going through here in terms of printing money is screaming, you know, they're battling deflation. That's what we think, you know, and so there's this deflationary scare. The first knee-jerk reaction is to sell the metals. And I know Chris and you have been talking about the Kapoom theory, and that we've got a deflationary crunch followed by an inflationary spiral. We too think that would be likely. The timing is what's really difficult. You know, we maintain that the undervaluation of the miners plus the fundamentals of the gold and silver market, you know, make a lot of sense. And certainly makes sense for us to keep our core position in the mining shares. And, you know, silver at these prices is just really cheap, even at where it settled today, just under 15, I think. It's like 115 or 120 to 1. Historically undervalued relative to gold. The trouble is finding it. It's hard to find right now. A lot of the dealers are sold out. Maybe you have some things to add, John.
I'll just add. So, you know, there has been, we've observed even in the folks that call us and talk to us, an increase in demand for people wanting to purchase some physical metals. You know, people are concerned, and rightly so, about, you know, kind of what's going on in financial markets, and particularly with, you know, kind of new stimulus and whatnot. You know, we think there's obviously there's near impossibility to get the physical product right now, but there's also some pretty steep premiums in those cases where you can. But we think there's a, you know, perfectly valid, you know, interim approach where folks could consider purchasing shares of, you know, there's a handful of traded, you know, mostly closed-end funds or ETFs that actually have physical bullion vaulted in very secure and audited locations. Not all those products are created equal. There are certainly some exchange-traded funds out there that purport to have physical bullion that, you know, are very suspect in terms of their you know, auditing and rehypothecation of those gold and silver bullion stocks. So we would steer clear of those. But these other ones can be used as a way to at least you know, capture any price appreciation, such that at such time where the physical markets kind of calm down a little bit, if they do, and product is much more available and premiums are not so great. One can swap out of those, you know, traded tools to secure some physical metals if that's what their objective is.
Okay, great. So a couple things to mention there. One is Peak Prosperity readers are familiar with the fact that we have referred people over to the Hard Assets Alliance in years past. We're also big fans of the folks at Gold Silver. That's Mike Maloney's operation. Both of those companies still do offer, we were just talking to them both recently, they still do offer the ability to buy physical. They're one of the few places where you still can. But I do think they're limiting purchases now to vaulted precious metals. And I think there might be a minimum of like 2,500 or something. But the good news is, look, if you're looking to get your hands on actually owning physical right now, those are two solutions that will still let you do it. To your point, John, there are ways in which you can get exposure to the price appreciation and do so still knowing that it's backed by physical gold. And I'm just going to say anybody who's interested in reviewing the options that are out there, just to call you guys and get your guys' opinions on the pros and cons of what else is out there on the table. And reading between the lines, John, it sounds like you're saying, hey, don't necessarily you don't necessarily recommend going into the major ETFs like GLD or SLV, which basically hold a lot of futures contracts. And those work fine until you get to a point of physical scarcity where there's a risk that too many holders of those futures contracts stand for delivery, and then it turns out there's not enough gold to meet all the different contracts that are out there, right? And that's the big risk of being in those big paper-only ETFs. So with all that, just one other question for you on this topic. What are you guys thinking about the miners? I mean, you would think that this would be net positive for the miners. The miners, I guess probably their big challenge right now is they're probably a number of mines out there that are shutting down because of the coronavirus, but those are obviously temporary challenges. We know that with the decrease in the price in oil, a huge percentage of their costs just got reduced because oil is a big input in the mining. And now it sounds like their main product is in extreme high demand. So you talked about how the miners had gotten beaten down recently. Does this in any way improve your outlook for the miners?
Yeah, well, a couple things there. I mean, first of all, we don't think this demand is temporary. And even so, obviously, it's one thing that we're being very observant of it, to the degree to which mining operations are affected by quarantines and worker disruption and stuff like that. We did have a conversation with a pretty plugged in firm that has some analysts and managers that really grill managements of gold mining operations, and as of this time there's not a material in our assessment a material impact on mining operations. I know Newmont Mining, for example, one of the largest miners, just the other day kind of gave a kind of a report, and I think they said something like 20% they're kind of electively kind of scaling back, but that for 80% of their mines, there is uninterrupted operations. And the thing you have to remember about mining shares is that they also control vast reserves of metals. So even if there is a temporary pause in some of the mining operations, they still have the reserves that essentially are what they're being valued at, and the kind of bringing those reserves to markets. So something we're being very careful and mindful of, and that's why we still have hedges in place. But as of this point, we haven't seen a material impact on the operations there.
All right, but to the spirit of the question, you guys still remain a favorable outlook on the miners, and do you see that outlook increasing, decreasing, staying the same based upon recent developments?
No, absolutely. We still have a very, very favorable outlook, and we think they're tremendously undervalued relative to their fundamental free cash flow, and certainly the price of metal and the dynamics we're seeing in the markets for metals right now.
Okay, great. Well, we wanted to keep this week's update brief because we all have lots of work to go back and do. I actually have to go launch today's coronavirus video in just a few minutes. But before I do, we have sent I think a record number of people to you in the past couple of weeks who have been, either rattled by the drop in the market and what they may have lost in their retirement accounts and their other portfolios. Either those types of people or people who have been sitting on the sidelines in cash, sort of expecting something like this to happen and now wanting to get positioned, even if this may not be the exact moment yet to do it, but they want to get positioned for it, positioned for the potential to start taking their dry capital and deploying it at attractive valuations into high quality assets. What are some of the top needs, issues, and goals of the folks that we're sending your way? Just because I know a lot of folks are watching this right now, and I want them to either, hear how you're treating the folks that are coming over to you and saying, yep, that sounds like me, I should talk to these guys, or no, that doesn't sound like me, this isn't for me. What are you talking with people mostly about right now that are coming over?
Well, Adam, we've been talking to lots of folks. It's been exhilarating, and it's been a lot of fun. And like you say, that the people that come to us have been pretty split. Almost 50-50 in my experience with the people I talk to. 50% of them are were over invested in the market more so than they really wanted to be, and they're unsure what to do next. And with those people, we're helping them, kind of giving them some advice, and helping them feel okay to reposition and sell into, the rally of the last couple of days to get themselves down to an exposure that they can feel good about. In our view, it doesn't make much sense to be fully invested in a passive model. 60 or 80% stocks is what we're seeing a lot of times. And if you're that invested in stocks, you really can't add to your stock position in the type of decline that we think is going to happen. So, and again, we think we're going to lose more than half of the value of the broad markets before it's over. So we're holding people's hand and helping them get down below, ideally, 30% equity. So that's half the people. The other half of the people are people that have been out for a long time. Heavy and precious metals. I talked to several people today and yesterday that have been out of the market since the 2008 financial crisis. And they're finally seeing the first major pullback in the market in over 10 years. And they know that they have to have a game plan on how to get in. And what they like about our firm is that we have a plan. We see things differently. We're very, very data focused. We're very, very used to using options and selling volatility, which means that we know how to hedge and enter the market using a layering technique and then collecting option premium that allows us to be slightly off in the timing, which is almost certainly going to be the case. And so with those people, we can offer a game plan and a structured way to enter. But overall, people are just looking for a coach, a team to work with that sees things the way that they see them. And we're having a lot of fun doing it. We really appreciate the folks that we're speaking to through the Peak Prosperity Connection.
Thanks. Well, we really appreciate you guys helping them, because we know that right now is a highly emotional time for a lot of people. And a really important part of being a successful investor is working with somebody who can help take the emotion part out of the decision making, right? Take it into account in terms of the strategy you're building, but take it out of the actual decision making so that you're not being driven by your emotions, you're being driven by sound logic. And again, I just want to thank you guys and commend you guys for the work you're doing for our folks. I've called it a public service in the past. I'm going to continue to do that. And our whole intent here is to make sure that anybody watching this, what we really want, we from Peak Prosperity really want, is for you to be working with a professional to guide your investment decisions at this time, and that professional take into account the types of risks that we talk about here at peakprosperity.com. If you've already got a great advisor for that, that's fantastic. Work with them. We're not trying to get you to switch horses, but if you aren't happy with your current advisor, or you're trying to find a good one and can't, we hope you give the guys here at New Harbor a shout. And we've worked out an arrangement with them because of the long-standing relationship we've had, because of the amount of volume that we send their way. These guys take their time out of their busy days to talk to any and all people that reach out to them. So the initial consultation you have with them is completely free. There's no strings attached. This isn't a bait and switch type of tactic. It's literally just talking with two financial experts that think very similarly about the markets the way that Chris and I do. So guys, with that, I promised I'd get you out of here with under a half hour. I hope I hit that goal. I will talk to you guys next week.
Okay, thank you very much, Adam, and thanks to everybody for listening in. Have a great day.
Thanks, Adam. Thanks, everyone. Talk to you soon.